Hello, and thank you for joining us for the Opportunities in Distressed Market webinar. Unfortunately, both Dave and Michael have conflicts today, so I will be joined by Dave Welk, a longtime friend and colleague here at Origin. What's an interesting fact about us is we actually started the year with the first webinar, and now we're wrapping up 2023 doing the final webinar of the year together. So I'm absolutely joyed to have him on the webinar with me this time. He oversees the equity for Origin Investments. Something you don't know about Dave is that he is a prolific dancer, not necessarily in the sense of being a tap dancer or a Broadway dancer, but really more of a string dancer. So, Dave, how do you feel about that accolade?
Well, thank you, Tom. Great to be on with you today. Yes, I'll accept that moniker that I am a quality dancer. It's something that I've been pretty proud of for a long time now. And the string dance has a long history. In fact, it takes us back to a holiday party of yesteryear, circa 2007, where the string dance landed me in the hospital. But that's for a different story for a different time. But I did get a helmet out of it. And this is totally impromptu. I didn't know Tom was going to do this, but I got my Let's Party helmet out of this as a result of the string dance. So, yes, thank you for that.
That's amazing. So if anybody watching this sees Dave in the market in Charlotte or Atlanta, please feel free to interrupt whatever he's doing and ask him for a demonstration of this string dance. In all seriousness, though, what I really enjoy about Dave is that he's an eternal optimist, which is a great counterpoint to my general pessimism and risk aversion. And so you'll see during this webinar, as you've seen in the past, that although I may paint a relatively bleak picture, he always sees the forest through the trees and finds great investment opportunities for us. So with that, let's start the slides, Jeff. What we're going to talk about today is what does it mean to be in a distressed market? What does it look like? Why do we believe the market is distressed today? How big is the potential opportunity set? And then Dave will jump into how Origin is prepared now, how we've been prepared in the past, how we've executed in the past, specifically during the GFC. Now, we don't think it's going to be this time around is going to be as bad as the GFC, but how are we prepared to take advantage of those opportunities? And then he'll wrap up with a couple of case studies of what we've done in the past, and then we'll go to Q&A. So let's start with defining stress versus distress. What makes something stress versus distress? And why do we differentiate the difference? In a stressed environment, we can mitigate the risks that are seen in the market or that are in the opportunity set that we're looking at. In a distressed environment or distressed investment opportunity, the challenges are more difficult to quantify, and the risks are a little bit less known. And so we try to focus our investment opportunities on the stressed environment and stray away from the distressed environment. And so what does that mean? And that's these bullets here. The first is that we look for isolated issues. So an issue that is idiosyncratic to a particular deal, something that's nuanced to that deal that isn't a widespread or prolific issue across a portfolio that is owned by the same sponsor or a large region geographically or something like that. So we look for idiosyncratic risk. And most importantly, or secondly, one that we can quantify. So we can say, hey, the cost to fix this problem is X, 5 million, 10 million, $20 million. And more importantly, quantifiable in the way that Origin has the expertise to solve that problem. So money is one part of the solution, but expertise is the second part of that solution. If you were to say, hey, we've got this hospitality stress over here and all these other boxes are checked, but Origin doesn't have the expertise to invest and succeed in hospitality, we wouldn't do the investment. Then we look for the cause. What caused this problem? Is it a systematic problem? Is it something that is in place because of something structural, or is it a problem that can be solved with time, knowledge, expertise, et cetera? And then finally, what are the potential solutions? Can we identify the solutions today? Do we know how to have a path forward to solve the problem that's causing the stress or the distress? and make sure that we've got a clear business plan to solve whatever problems are in place. An example of this and how they can be evolutionary, how these investment opportunities can be evolutionary or evolve from what you think is stress to distress. I had a friend of mine who's been in the business for 20 years plus, and I've known him for most of those in the real estate business. He has a very successful development company. And he called me a few months ago and said, "Hey, Tom, I have a project which I have developed, and it's in lease up right now. The problem I have is my loan is expiring in 30 days, and the lender wants a pay down because we aren't at a point of stabilization, so I can't truly refinance it yet. So I need this kind of bridge capital that'll maybe be 9 or 12 months in duration. And at that point, we can refinance and put it on permanent financing and everything will be fine. But the lender, the senior lender wants a pay down to protect his risk and because they need liquidity as well." And I said, "That's interesting. That feels like a stress situation, not a distress situation. Let's tour the property." Everything at the property checked out. There was no major idiosyncratic risk at the property. There didn't seem like there was anything pervasive that was really slowing lease up or causing the need for a pay down of the loan. So I was getting pretty excited about it. And I asked him what else was going on in his portfolio, just making conversation. He said, "Oh, actually I had this same issue across 4 or 5 other assets across the Sun Belt." And that really put up a red flag for me. And I said, "Well, where's your LP?" Because it's the same partner that he has across all these deals. And we're talking about hundreds and hundreds of millions of dollars of opportunity here. So where's your LP? He said, "Well, they actually have a bigger issue." I said, "What do you mean? We're talking about hundreds of millions of dollars potential loss if they don't step up and they have bigger issues." And he looked me square in the eye and he said, "Yeah, their issues are much bigger." Now, I don't know who the LP is. I do now, but I can't divulge it. And I don't know what their bigger issues are. But I do know that when you have a problem that's that pervasive, it violates the widespread, the very first one. It's a widespread issue. It's a non-quantifiable issue because I don't know what else is going on in that portfolio. I don't know what the cause of that LP's problems are, and therefore I can't come up with any potential solution. So what I thought was really an interesting stress scenario to begin with ultimately became an environment where we couldn't do the deal. It's unfortunate because he's a friend, he's a person I like a lot, but we just can't help in that case because we can't quantify the risk and we can't really come to a solution in a clear and concise manner. So Jeff, let's jump to the next slide. So show me a sign. What are the signs of distress and distress? As a lot of people on viewing the webinar right now might guess, is the world feels like a pretty good place to be right now from an economic perspective. The unemployment rate is very low at 3.7%. Anybody who wants a job today can have a job today. The 10-year, which we celebrated last week, finally crossed back below 4%. It's at 3.9% today, at least as of a few minutes ago. And so all this feels really good. And then last week, the Fed starts talking about rate cuts, and the world feels like we're in a really good spot. So what stress? How can we tell that there's stress? In the real estate environment, it's a lot different than the macro environment because of the rising interest rates that have been happening over the last year and a half or so. And the thing that's most obvious to me, the way I know that there's stress is that people are looking for more information. I start fielding phone calls from people who I maybe talk to once a year or every other year or every 3 years. This happened a lot at the beginning of COVID. People are trying to get information. There's just less transparency in the system. In moments like today and like during COVID and during the GFC, and people want to talk. What are you doing? What are you seeing? Where are you making investment opportunities? Where are you seeing investment opportunities? Where are you actually pulling the trigger to make those purchases or those dispositions? There are so few transactions in an environment like we have today that it's really difficult to gather data unless you're active. And so Origin is historically seen as one of the more active groups in the real estate space, especially in the multifamily space. So people reach out looking for information. That is how I know that stress is in the market today, is since really this summer, people have been calling pretty regularly. Some of them I talk to on a regular basis, monthly or quarterly, and some I haven't talked to in several years. And they're saying, "What are you doing? What are you seeing? What should I be doing?" More importantly. And so it's if we knew nothing else, but I just saw those phone calls, I know that there's stress in the market. When you start seeing deal flow in multifamily loans, meaning borrowers or lenders are selling loans at a discount to fair market value or par value, that's how you know distress is starting to creep into the environment. That, although I said stress was starting to creep in the summer, distress is absolutely in place now. We started to see loan sales really in the last week or two in some pretty large deals in Las Vegas and Texas. And I actually had one come across my desk this morning. And it's a really interesting story. And I think it's prolific across the economy, the United States right now, where the stress is starting to turn to distress. Those loans are starting to sell. And this quick story was multifamily opportunity, late 90s developed project that was bought in the absolute peak of pricing in December of 2021. So folks who have following Origin know that we haven't actually acquired an asset since March of 2020 because we saw the pricing escalate to a point where it didn't make sense for us to buy anymore. So we actually haven't actually acquired a deal coming up on 4 years. And it's been a really long drought. And the reason is about the pricing was totally out of whack. So this Austin 90s vintage multifamily, high quality B plus A minus asset in Austin, well located. The borrower paid $87 million for it in December of 2021, which I would qualify as the absolute peak of pricing during this most recent asset run up. They borrowed 83% loan to value, or roughly $72 million. So very high price paid, very high loan to value leverage. The BOVs came back last month at $54 million. Again, they paid 87. The asset is now fairly valued at 54 million. That means all of the equity that they invested is gone, and up to or near $20 million of that debt is going to be wiped out as well. So it's really unbelievable, the run up that we saw. The asset pricing has come back down. This is somewhat of an extreme story, but I think you're going to see more of it. We certainly are seeing more of it in 2024, and Dave will talk more about how we're ready to do that here in a minute. So why are we seeing this stress in the market right now, Jeff? So the short answer is we're seeing declining NOIs. In addition to all the credit stuff and all the financing that we've talked about, declining NOIs are really a driving factor in valuations today. The first part, and what we're showing here, is that revenues are declining. This is specific to vacancy increasing. So as vacancy goes up, rents tend to go down. And we actually put out our report in December of 2022, based on our multi-analytics forecasting, that rents would decline in 2023. And so far, year to date, we've been accurate with our rent deceleration forecast to the tune of about $2, with an accuracy within $2 nationwide. So a very accurate rent forecast. We saw the supply coming and the vacancy increasing, and we saw the decrease in revenue as a result. What you can't see in this chart is that there's more supply coming. The next 12 to 18 months should see additional supply. And I would expect that vacancy rate to creep higher than the 5.5% we have today. Again, 5.5 versus 5% historical trend isn't that impactful. I think that the reason revenues have decelerated, rent growth has decelerated, and revenues have gone down as much as they have, is because the market is anticipating that wave of supply that's coming over the next 12 to 18 months and is taking corrective action proactively. And we'll see that coming further in 2024. So I'm not as concerned about 5.5. I do believe that we'll return to that 5% long-term average and even tighten up beyond that because of the structural need for more housing in this country. And Jeff, let's go to the next slide and talk about that stabilization. This is, again, the multi-analytics forecast for rent growth in the Origin target markets, which are generally in line with the national average going forward. We believe that we'll outperform rent growth slightly, but the dark green squares, rectangles, are the 2024 forecast, and the light green are the 2025. And so what you can take away from this slide is that we will continue to see some softness in 24 as we work through that 12 to 18 month supply that I just mentioned. But by 2025, we should see a normalization of rent growth back to the historical, what I'll call inflationary normal, of 2 to 3% per year across our markets. Again, some markets like Phoenix will outperform in that 6 to 8% range, and some like Atlanta or Dallas should be in that more normalized inflationary market. So revenue has taken a hit over the last 12 months. I believe that there will be continued softness in the revenue side and should stabilize in 2025. Next slide, please. Part two of this NOI challenge are expenses. As we were just talking about, whether you're talking about used cars or the price of Lion King tickets in Broadway, inflation, these are not the only things being affected by inflation. The expenses, the operating expenses at the property level are also meaningfully impacted by inflation. The specific expense that we're targeting here is insurance, where we're showing anywhere from 20 to 40% insurance increases year over year across all of these markets. It's certainly more prolific in the Southeast. In this case, we're showing Charleston and Orlando as the most impacted, but it's across the board. It's Las Vegas, it's Phoenix. The insurance companies have been so hard hit over the last 2 years with fires, with floods, with hurricanes. They have been losing money. And so they're trying to get their insurance premiums to a spot where they can start making a profit again. We, again, do expect this growth of insurance to stabilize in the next couple of years and even come down by quite a bit. But for right now, we are dealing with a higher insurance load across the board. That's just a small piece to the total expense budget. You still have payrolls that are up, utilities. My home electrical expense is up 3x year over year. So we're seeing this expense load increase across the board and really impacting NOIs at all the properties. So everything else equal, when you have your net operating incomes decreasing, your profitability at the property level decreasing because of a drop in revenue and an increase in expenses, you can expect values to decline. You can also expect the debt service coverage or the amount of cash available to pay the debt to decrease. And at the same time, when you have all of that, you have your loan to values increasing. So all of this is a perfect storm, especially when combined with floating rate debt that a lot of participants put on in the absolute peak of market pricing in 21 and 22 to lead to stress and distress in the market environment. So let's jump to the next slide, Jeff, and let's talk about how big this problem might become. The chart on the left is total loans expiring 2023 through 2025 across all asset types. And on the right is the multifamily specific expirations and maturities. Let's focus on 2024 and 2025 for a minute, because 23, for all intents and purposes, is over at this point. Although, like that Austin asset I mentioned earlier, that is a 2023 expiration that is going to be sold in 2024. The total loan maturing in 24 and 25 across all asset types is roughly 500 billion, or said differently, $500 billion of expiring loans. The really nice part for Origin by design is we don't have to worry about the office, industrial, or retail. That takes away roughly half of that stress. And frankly, that's most of the distress that we'll see in the markets are going to be specifically in the office and to some extent in the retail space. We are lucky enough to be able to focus only on the multifamily. And over the next 24 months, we're seeing roughly 240 to 250 billion of loans that are expiring or rolling over that 24-month period. And so again, these have lower NOIs, which means there's less debt service coverage. There's higher cap rates in place, which means between the NOIs and the higher cap rates, the values have decreased. And then lower values plus lower debt service coverage equals stress. So all of that brings back to what we talked about at the very beginning. We are looking for quantifiable, isolated problems with idiosyncratic risk, with problems that we can solve. And so I painted a relatively bleak picture here of what the world might look like, the distress that we're starting to see creep into the environment. I'm going to stop being a Debbie Downer, and I'm going to pass it over to Dave for how we're going to take advantage of some of these opportunities and hopefully turn it into a profit.
Thank you, Tom, and great to be on here to help close out the year the way we started it. And also hope that you're able to find a way to barter for those Lion King tickets on Broadway this week. Good luck on that. As Tom mentioned, I'm going to wrap up the rest of this discussion by discussing how Origin's well positioned to execute in a distressed market environment. Some of the things that are different today that existed in 2008, and then what we look for in distressed opportunities. And then, as Tom mentioned at the beginning, I'm going to walk through a couple of our post-GFC case studies of distressed deals that we did here at Origin that produced some pretty compelling returns. So that's a little bit of will be my optimistic tone here. So to start off, how are we positioned here at Origin to execute? And a little bit of the history for those of you who are newer to the Origin story, but we as a firm were created in the ashes of the great financial crisis in 2008. And so there were a lot of lessons that were learned from the practices that existed during that leading up to that time frame, especially regarding the use of leverage. And what this has done is really shaped our active risk management practices, and it ensured that we matched our loan maturities to the underlying business plans of the properties that we invested. It also helped as we moved on through our development portfolio in the last couple of years. We couldn't execute on some of our swaps that we do to hedge long-term interest rates. So it also helped inform our interest in execution of swaptions. So for those of you who tuned into prior webinars, you've heard about how we've used derivative products to hedge long-term interest rates for deals that are not quite yet stable yet. Another one of the benefits that we have here that's helped position Origin to succeed is that our senior management team is the exact same today as it was then. Dave and Michael remain as our co-CEOs. Tom and I joined the firm within a few months of one another in 2011. So we, along with Dave and Michael and other key team members like Mark Turner and others, followed shortly thereafter. But we've been together for a long period of time. We helped build the firm out of the distress environment, and we'll talk a little bit about the performance of those early funds. But the playbook that we executed then is what we'll be executing now. And the environment's a little bit different, but the same team is here leading our investment products today. The management team that existed today that did then, I was a top decile manager that produced returns for Fund 1 and Fund 2 of 28% and 19% respectively. So those were certainly highest of our top 10% of our cohort, who was also deploying capital at that time. We did about 30 deals over that time frame from 2011 to 2013, 14-ish in the Sun Belt and mountain regions. And we did that all from Chicago. How we're much better positioned today is that we have boots on the ground. We built out our office presence in our 4 main investment markets. So we have folks in the regions that we invest. And what that's done is help provide for superior market knowledge, but also relationships as well. And what's also different about us today is our access to capital, which we now have over 4,000 unique investors. And we've built a reputation from those early days in the post-GFC investment climate for developing creative solutions within the marketplace. So what that's done is that's moved us to the top of the deal flow list with sponsors and intermediaries. And today, probably most notably, is that our investment products and capabilities span the entire capital stack. Tom, who oversees our credit operations, sees many, many different whole loans, executions in the marketplace. We continue to be one of the market leaders in preferred equity. We're seeing through our various other fund products, joint venture opportunities. We continue to track direct acquisitions. So we're seeing almost every single deal that comes across the markets that we're in. And we have what I feel and have continued to tout for many years now is that we have an unrivaled ability to determine relative value across the entire risk spectrum. So we can understand, what in deals in certain markets based on the basis and returns that we can get, sponsor profiles, so on and so forth. We can rank deals. What are the best for our various fund products? In 2016 through 18, which was a period of time where there wasn't distress in the market, our investments team developed a playbook for sourcing off-market opportunities. And so what we've done is we've dusted this playbook off now, which includes creating databases of tracked deal activity, and we track it and cut it up by market and product type and sale date, owner profiles. We've got a lot of different fields that go into this database of opportunities. But notably, we're tracking debt maturities. And now we've taken what we did in 2016 through 2018 and supercharged this analysis with the inclusion of multi-lytics. And so what that does is it spots distressed opportunities, but more importantly, the distressed opportunities that highlight the highest growth potential for rent growth potential over the near and long term. And to that point, multi-lytics has been a game changer for us all in our ability to augment and incorporate AI into our data analysis. So now we can understand how billions of pieces of information all come together to tell a story and really to help ultimately predict the future. And multi-lytics has done this with an unprecedented industry-leading accuracy for rent growth. But we've also recently built out capabilities for the platform to include operating expense analysis. And Tom touched on this earlier about this becoming one of the most challenging things for any investor to underwrite. Most challenging aspects of the underwriting process altogether is to understand exactly how rent or expenses are going to impact your overall pro forma. We've taken out this forecasting ability to also incorporate CPI forecasting. So now looking at inflation, which fuels the forecast for operating expense growth. And we've also bolted on inflationary indices for construction pricing. And the final frontier that we're working on is an interest rate forecast. So multi-lytics is certainly one of the elements that has differentiated us now from where we were in 2008, which is a great segue to the next slide, which is what's different from 2008 today. And rest assured, this time is different. This is not 2008 for a host of factors. And there's several reasons why, one of which would be the amount of dry powder. And that's a term that we use a lot in the industry, which is basically the amount of investment capital that has been raised to invest in US real estate. So we have about 4 times the amount of dry powder in the marketplace today that existed in 2009. Now, some people said, well, that's great. It didn't really come off the sidelines in 2009 and 10, at least not for a while. What's also different about this time around is that leverage is still available. So in 2008 to 2010, you really couldn't get financing of any kind. The credit system effectively was shut down. This time around, and thankfully multifamily has the government-sponsored entities, notably Fannie and Freddie and HUD, that are not plagued by any sort of banking issues. Still very much open for business, providing much-needed credit and liquidity to the marketplace. Life companies are still very much an active part of the marketplace. They're still seeking to expand their loan books for multifamily, so that's another active part of the financing marketplace. Again, very different environment in 08. So because when in an environment where you don't have leverage and you're solving for an equity return, basically your unlevered return has to be, your levered return. There's no debt. So if you're trying to solve for a quote unquote distressed rate of return, call it mid to upper teens, that's going to create more distress on pricing that will exist without leverage in the system today. So the fact that there's debt available, I think, is a key difference between now and 2008. One thing I thought was interesting to point out that it is the same today as it was in 2008 is that and Tom noted this, 10-year Treasury just retreated sub 4%. The 10-year Treasury today at 3.9, roughly 4%, is actually identical to where it was in October of 2008, which was right after the collapse of Lehman. So that is maybe the one thing that is similar to today. It provides some perspective on just exactly where we're at as an industry, as a marketplace. But the other things that are going to help stabilize the industry and suggest that we're not heading to 2008 levels is the fact that operating fundamentals are still, by every stretch of the imagination, historically strong. National apartment vacancy is still hovering in the 95-ish, 94% rate. And what's different this time around than last is that we don't have the threat of this shadow inventory from a housing collapse that occurred in 2008, which created basically even more supply and available of substitute goods in the rental market. 80% of all homeowners in this country have a fixed long-term mortgage rate of sub 5%. So the fact that we're not having this variable rate debt that burned off in 08 and 09, that created the subprime crisis, that risk is really contained. So do we think that we're going to remain at 95% for the next year or so? Tom touched on, historically high deliveries of new product in the next year. No, I mean, some of the occupancy rate will go down from here from 95%. But again, to put it in perspective, the trough occupancy rate in 2008, 2009 was high 80s. I mean, 90% at its best. So there's still some deterioration that can happen. I don't think we're going to go anywhere close down to 88 to 90. But the point is, we're starting from a very strong place. And that's another strong place we're starting from too, which is unemployment. Unemployment in 09 peaked at around 10%. And we recently had a print in November of 3.7% unemployment. So we do expect some job losses to happen in 24, but ultimately, and this is not the house view speaking per se, but I think collectively, a number of folks with an origin feel that we're going to be peaking closer to like the mid to upper 5% range. So far cry from where we were at 10% in October of 09. And that's going to create a lot less stress when there's a lot less unemployment. The folks are not going to be abandoning the household formation as quickly and running to seek roommates, which is really what helped create a lot of the distress in 08 or 09, is that household formation collapsed. And then lastly, we've got lending guidelines that were put in place after the GFC. So we've learned some things and put some guardrails in place, and notably some of the regulatory provisions that came out of Dodd-Frank and Basel III really resulted in much better stability within the banking system. And we talked a little bit about this in our webinar from last week regarding some of the predictions for next year, and wrote an article on that actually over the weekend, that we're actually about to see another wave of banking regulations hit some of the smaller banks. I think it's called the Basel III Endgame. Sounds like a Marvel movie of some sort. I'm not even making this stuff up, but it's going to impose more restrictions on smaller banks, and it's going to create even tighter lending standards, which will really, stem some of the flow of capital for next year. That's going to create some distress. Tom walked through some of the maturities that exist in the marketplace, with some capital being pulled out of the system through enhanced lending standards. That's going to help create additional distress in the marketplace. But the offset of that is it's going to substantially reduce systemic shocks into the banking system. So on the next slide, we'll talk a little bit about what do we look for in distressed assets. And really, we look for the same things that we look for in non-distressed assets. It's good quality properties with strong physical attributes. We call them in the industry, having good bones, meaning some of the structural elements of the project, things that you cannot change through, renovation capital, such as ceiling heights and adequate amenity space. Those are the things that we look for. A lot of the other things, the deferred maintenance and upgrades to the units, those can be fixed through capital. But those are some of the elements that you cannot, no matter how much money you throw at a property that has 8-foot ceilings, unless you tear the project down, that's something you can't overcome. So we're looking for those types of attributes physically. Location always matters. And then the difference now is that we can utilize multi-lytics to help us analyze the growth prospects of location. And we talked a little bit about that previously. But what this does is this supplements the observations and experiences that our officers have from living and experiencing life in their markets. So now we have an unbiased way of helping us to quantify growth in a marketplace. But now more than ever, we look at especially when we're evaluating credit or as a joint venture on the equity side, it's critical to do a thorough investigation of the borrower and the partner, really on their investment, on all aspects, but on their investment history, the status of their existing portfolio. You know, we want to understand that if we're looking to partner or lend to a particular borrower, that this individual property that is in some level of stress is not systemic. That's going to create a wave of bankruptcy across the borrower's portfolio. So really understanding the makeup and the quality and financial strength of the borrower's and partner's portfolio is critical. And going along with that, reviewing contingent liabilities, meaning how many other loans borrower or partner have guarantee obligations for, and does that create a cascading effect of issues if one loan goes bad? How much liquidity do they have to help stem some of these issues that may that may arise through distress? Looking at their legal history, you know, have they been involved in bankruptcies or foreclosures? All kinds of things that go into looking at the financial health of the borrower. One other thing too that we look at is the vertical integration of the borrower and sponsor partner with either construction activities. So they own a general contracting firm. Are they completing the construction work themselves? And are they the property manager? Because both of those two things have their own underlying risks that we need to understand, and frankly are just hard to execute on. If the partner borrower is not executing the construction well, removing their construction teams on site, same with their property management teams, that's not a quick and easy thing to do. So we want to understand that there's inherent risks in that removal as well. Important, really, as noted on the slide here, is that we're looking for assets that are distressed, not firms or companies that or borrowers that are distressed. And when the capital structure is broken, like for example, the debt maturity today is causing an issue, values are suppressed, and right now you're at a point in time that's causing the opportunity for stress or distress. Not so much that the underlying quality of the real estate or the sponsor, like I just talked about, is the issue. Those are things you can't fix ultimately. So making sure that we're looking for the properties that are distressed is the key. And then as such, every deal that we look at is in isolation. And we spend a lot of time to understand the respective fundamentals, and each deal needs to really stand on its own. So I'm going to jump to a couple case studies, as we mentioned, from the early days at Origin. One of the Marquee Trace is shown here as a Fund 1 investment. And this was actually one of the first deals that I closed at the firm. So this closed in December of 2012. This was an Atlanta deal that I actually acquired my very first deal at Origin a year prior, also in suburban Atlanta. We acquired that asset for $14,000 a unit, which is less than land value today in many of the suburban markets in Atlanta, but elsewhere as well. But this particular project, Marquee Trace, is located in Roswell, Georgia. And Roswell is a relatively affluent, high barrier to entry submarket in the northern suburbs of Atlanta. And this project came to us because it was a mismarketed opportunity. There was a broker that had this on the market, and this property sat within a larger 100-acre parcel that had roughly 60 acres of vacant land, along with the acreage that these 300 and some odd apartment units sat on, which was about 35 acres in total. So it was really being sold to developers as a redevelopment parcel. So it required a rezoning to rezone for higher density mixed use, but it was what's called a covered land play, which means you can get cash flow from the existing multifamily while you spent the time to redevelop the property, and you could sell off portions of the site. And we tried to rezone the property as the broker had marketed, but we also knew that we needed to invest in the underlying multifamily in the event that we were not successful in our rezoning, so we could drive cash flows for the property. Well, what happened is we tried to rezone the site for over 2 million square feet of mixed use, and the neighbors and the community at large showed up at the zoning meeting literally with t-shirts on, everything except for pitchforks, and tried to shut us down, and did shut us down. So ultimately we were unsuccessful in rezoning the property, but I think the marketplace had completely undervalued the value of the apartments here. So we acquired the underlying apartments for roughly $35,000 a unit, completed a modest renovation plan, and then sold it for $95,000 a unit. So not quite 3x unlevered, to an investor who frankly just saw the apartments for what they were, which is a quality workforce housing opportunity in a submarket that frankly, and we had the perfect backstory to articulate, no new development is happening in the submarket. And I like to note here that this is tied for I believe, the highest multiple on any investment here at Origin. So proud moment there. So our next case study is actually a Fund 2 asset, which is Lux 24. Interesting thing about this deal, we acquired this project in mid 2013. So this is a full 5 years from after Bear Stearns collapse. So just to give you an indication of how long the distress existed post 2008, 2009. I mean, there were still opportunities that were available in 2013. So this was a partially built condo project that really had been mothballed by the lender. Funny or interesting story here, this was embroiled in a Ponzi scheme by a developer in Chicago who courted foreign investor capital. So we ended up purchasing the note here and actually ended up finishing out the construction of the units. There was a handful of units that were not finished. A couple were in shell condition. They needed, flooring, kitchens, countertops, the whole bit. A number of the units were almost ready for operation. They just needed appliances or one of the bedrooms to be finished out. So we finished the construction. We bought back a handful of the units that had been sold to individual condo owners, and in doing so, we collapsed the homeowners association. We slashed expenses as a result of that, and then we sold the deal a couple of years later to an opportunistic 1031 buyer, and that buyer ultimately turned around and sold the property a few years later, actually at a lower price. So we knew, even at the time, we had an aggressive buyer at a price that was much higher than we could justify holding the asset. Lo and behold, produced a nice, pretty juicy IRR. So most of the building that has occurred in this most recent cycle here was rental multifamily. We saw very few condo opportunities delivered in our markets. To the extent that they were delivered, they were boutique in nature, 20 units, 30 units here and there, and targeting a very affluent demographic. So we're not going to see this time around really many, especially in our markets, failed condo development opportunities. We certainly had our fair share of those in Funds 1 and Fund 2. I think we did a total of 3 or 4 of those. Don't see those happening this time around, but we are going to see is a number of opportunities like Tom mentioned, which are lender-driven sales where the lender themselves are going to take a discount to their note value, functionally sound apartment projects, but really ultimately just got caught up with some timing issues in the market cycle. So that is the end of our presentation here. But as Tom mentioned at the outset, I'm very excited for the opportunities that are going to present themselves in 2024. We're in a great spot to execute as a firm, and we've been patient for the last almost going on 4 years now. Our team is ready. We're ready to get back in the market and start buying again.
No doubt. Thanks, Dave. I'll answer the first question. I'll lob a question at you. And then as people think of additional questions, as we talk through the Q&A section here, please feel free to lob them into the chat section, lob them into the Q&A section, not the chat section, so we can keep track of which ones we've answered and which ones we have not. The first question we saw was from Robert. Consolidated question is, have we ever considered investing outside of the multifamily space, whether it's industrial or technology, commercial real estate? Yes, we have. As Dave noted, in our first funds, we have invested in industrial, office, and retail. We won't anymore, however. This is an often covered topic internally and from our strategy conversations. We will stick to multifamily. There's a huge amount of opportunity for us in the multifamily space in the United States and in our target markets. And I don't think, we can deploy a tremendous amount of capital in really high quality investments without straying from our expertise, which is multifamily. So Dave, I'm going to lob to you the next question as it relates to QOZ3. It's a kind of a two-part question. I'm going to combine two anonymous attendee questions here. The first is, what's the rationale other than taxes to invest in QOZ3 versus waiting for a distressed higher return opportunity? And along with that, can you talk about some of our land holdings in our QOZ portfolio today?
Yeah, I mean, great question. Why invest in ground up development for QOZ3 versus waiting for some of these distressed higher return opportunities? And I think that's the operative statement, is higher returning opportunities. And so Tom you mentioned a couple of deals that we've taken a look at as of late, and hard to quantify, how deep this market is going to be for distressed assets, and how much more maybe pricing could fall. But we have underwritten these opportunities, the few that we've seen, and they've definitely been outliers. And I'll just say, because of where the leverage is at in the marketplace today, they're not quality returns. I mean, I believe we're going to see them at some point in time, but we're not even close to generating the same level of unlevered or certainly levered returns that we're seeing in development still today. And as an example, we're looking at these couple deals. One deal that we talked about in Tempe on our webinar last week, it's going to trade at, we think, a 5 to 5.25 on our numbers. You pair that with 6% fixed rate debt, your negative leverage on that particular investment for 4 years, until you can grow your way into positive leverage. On the development side, we're still finding opportunities that are a 6 or better, based on today's construction pricing. And granted, they're very difficult to find. And so what I think we're going to see now for OZ Fund 3, and this does somewhat answer the land position question, some landholders in our various markets are going to be coming to us saying, look, we realize that returns are tight, and we're going to count our land price, or subordinate a land price, or subordinate our fees. And we've already started to see that from some of our partners in the marketplace to help enhance those returns and create the separation in returns that you can generate from existing assets. So I do think that and on top of that, we're looking at growth opportunities in our markets, right? Ensuring that we're using multi-lytics to find the highest performing rent growth submarkets. That might not be where all the distressed assets lie, too, by the way. The distress could be in markets that we're forecasting have very low rent growth propositions. So there's a lot of considerations that go into it. On our land holdings, we do have some opportunity zone acquisitions that we've made of land sites that are, we've been working through our pro formas over the past year or two. Pricing has moved on us, and we've talked about this in some of our webinars. But in a couple of our deals in particular, we have the ability to move around land allocations, so Edge Hill and Sawtell, as the market recovers and moves forward. We can allocate, on some of our earlier phases, a lower land basis, and move some things around to help ultimately the economics of those deals work. we are going to move forward with the lion's share of the OZ land holdings that we have, but we also are looking at selling some of those land positions and with the intent of trying to recoup as much of the initial investment that we've made and then redeploying those into deals that are producing those 6 and higher level returns. And we've done the analysis on this, and our goal is to ideally extract profit if we can, but being realistic, we may get out our basis or may actually have a little bit of a reduction from our investment basis. But the ability to redeploy that into a shovel-ready deal that's going to produce a 6 is a much better investment outcome for those projects. So we are looking at actively selling a small handful of some of those OZ sites, but the vast majority of the ones that we are moving forward, and we're figuring out ways to structure them in ways to protect our capital, our investor capital, by negotiating fee reductions with our sponsors, our developers, subordination of land bases, everything we can do to enhance those returns to get them to a 6 or better.
All right, there's a couple of questions here that I will address all at once, and then Dave, you can jump in, but I'm going to address 2 here. The first is, has Origin ever been wiped out 100% loss with any distressed investment? The answer is no. All of our distressed investments, really the distressed investments were, as Dave noted, from call it 08 through 14, maybe Lux 24 is the last one, 2013, somewhere around there. All of those were phenomenally performing assets. So I think that, certainly past performance is not indicative of future results, but as Dave covered, we are in a stronger position today than we were several years ago to take advantage of those opportunities. The next one is probably 7 questions on, are we starting a stress or distress fund? Where are the investments going to go? The short answer on that, which is not terribly short, is it depends on what the investment is in the near term. As Dave noted, it's really difficult to quantify how much stress or distress there will be in the marketplace and what lenders specifically are going to do about it. For those of you who are in the real estate space back in 2015 and 16, there was a lot of conversation about this wall of maturities that's coming in 2016 and 17 because of loans that were originated in 2006 and 7 at astronomical valuations, and that they were 10-year loans, and when they expire, there's going to be a lot of stress and distress in the market. That wall of maturities, while those assets did roll, right, you had refinances and sales that took care of those issues, there's no real stress or distress that came along with that. Because when there was a challenge, a lot of the lenders did what we call an extend and pretend. They gave them another year to figure it out or 2 years to figure it out. And so long story short, it's really challenging to forecast how much stress or distress there will be in a market. And so we're not going to launch a fund to put out $200 million, $300 million, $400 million into this market until we understand that there is that type of opportunity set to capitalize on. In the near term, what we'll do is move those investments based on where they fit into the appropriate funds. So the credit fund has the opportunity to buy distressed notes, performing and non-performing notes at discounts. Income Plus fund can buy distressed assets at fair market value or discount to fair market value. And the third bucket of capital will be sidecar opportunities. So as we find these opportunities in the market, they'll be allocated between the appropriate funds or a sidecar investment opportunity for our investors. Those will be offered first to current fund investors, whether it's Income Plus, Strategic Credit, Fund 3, et cetera. And then from that, there'll be sidecars. And then if there is enough opportunity set out there, we're discussing launching a fund. But at this point, we just haven't seen enough to warrant a full fund.
Tom, just to finish up that point, John asked a question, are we going to be using the Strategic Credit Fund to capitalize on any of these opportunities for distress?
Yeah, the SCF does have the ability to buy distressed notes. It cannot buy physical real estate, so it won't be buying that asset that the bank is selling because they've already foreclosed on it. But what it can buy is a note at a discount, right? So 60 cents on the dollar, 70 cents on the dollar, with either the intent to work out and create some solution for that borrower, or to sell it at a higher note price later when some of those problems have been solved. So it does have the capacity to buy notes. It will not be buying physical real estate.
Just to close out a question from Anonymous who asked a question about earlier about historical losses on distressed deals. There was a follow-up to that, which was, didn't Origin Fund 3 face 100% loss on one of its office assets? And that is correct, Anonymous. We did, that is the only deal that we have lost principal investment on in the firm's history. I think prior to that, our lowest returning deal was a student housing asset in Fund One that still eked out, Tom, if I'm not
It was
mistaken,
an 8% maybe.
yeah, 8-ish, 9-ish% return. Um, so that is definitely the one loan asset where we have lost um, any principal, all principal, and didn't return positive return. That fund is about to be wound down, but we had a lot of early wins in Fund Three that absorbed the loss from that office asset. And very proud to say too that the question came up: are you investing in other asset classes? Uh, no, we're not an office. One of the reasons why, because of that particular deal, but just really the risk reward this was pre-COVID, made the decision to pivot away from office investing. So yes, that is true that we did lose principal on a project in Chicago. Tom, anything else?
I'll chime in on this note from Steven. And I think I'll answer my thoughts, and then I'll have you chime in on yours as well. Steven asks, will you discuss lessons learned from your worst performing asset? Whether it's worst performing or sometimes it's just brain damage, partner matters. And by brain damage, I mean you spend a lot of time not achieving a lot, whether it's returns or progress or whatever the case may be. You can spend a lot of time on an asset and not make real progress on it. I consider that brain damage. And that it make partner selection is absolutely critical. Partners have the ability to make or break a deal. And the student housing deal that Dave noted earlier partially was a function of being student housing, and we were not experts in that space. And so the returns were not maybe what we had underwritten, but also we had a partner who wasn't fully transparent. He was obstructive. And it was a real challenge to squeak out that whatever that return was, 8, 9, 7%, because partnership is absolutely critical. We have put more scrutiny on partnership risk in the last 10 years, really the last 3 or 4 years, than we had at any time before that. And I would note that as we go through new deal opportunities today, we really spent a lot of time on investment committee talking about the sponsor, talking about their expertise. We no longer invest in markets where it's the first deal opportunity for that sponsor in that market. So if they have a huge presence in the Southeast, and they're in Charlotte, in Atlanta, in Florida, but they're going to jump out to Las Vegas, no, pass. They just don't know enough about the market. And I think that's probably the biggest lesson learned for me over the last decade from our worst performing assets.
No, well said. I mean, the only other thing I would add to that, and this has come up a lot internally. We've talked about it as a group, and Tom mentioned previously about us launching a distressed asset fund when we see more and more of those opportunities, and we absolutely will. But it's early yet, and it's hard to know, especially with what happened in the 10-year reversing last week. I mean, the levels of distress start to feel, again, this is my eternal optimist hat being put on here, but we may be stemming a little bit of that distress. But ultimately, one of the things we talked about is what types of assets are we going to look to acquire in a distressed fund format or in just an individual deal format. And the deal that I mentioned, Marquee Trace, the case study, and the other deal that I mentioned to you that we bought for $14,000 a unit, the ultimate definition of distress. We didn't eke out $1 of cash flow in either one of those deals. And talk about pulling your hair out. I mean, just managing the clientele, being concerned about just operating at 20% economic vacancy. it's a tough way to, I mean, there are groups that are out there that do it better than others, but we've decided as a firm that we're moving up the scale in terms of asset quality and renter profile. So lessons learned from those deals, great performing assets, don't really have a desire to own those long term again. So the one other thing I wanted to answer, well, I could take two questions real quick. I know, Tom, you got to run here at 3 o'clock, but the one of the questions came up about condo conversions. I think Gene had asked that question, and also sent it in beforehand too, which is, love that question because I'm a recovering office investor here at Origin, so I still love office and deep in my heart. And if I can figure out a way to make it work as multifamily, all the much better. And we've looked at pursuing a number of opportunities there, both as pref, as OZ, as common. We've looked at a lot of deals, frankly, around the country. They're very difficult to make work. And I'll say that it's a fun headline. It garners a lot of attention. You know, this is how we're going to save the office stock in this country. We're going to convert everything to multifamily. There was a study that was done by Gensler. I think it was something like less than 1% of all office stock is eligible for conversion to multifamily. And there's a lot that goes into reasons why most of these deals don't work, is because the physical structure doesn't allow for you to convert to multi. Floor plates are not optimal, plumbing chases are not optimal, window lines, you know, center core, elevators, all that goes into it, and how you can demise up an office floor plate into a serviceable multi-family floor plan. So are we tracking them? Yes. Would I love to get one done? Only if it makes economic sense.
Well, I'll answer one more question, then I'll sign off. And unfortunately, if you do decide to do a string dance, I'm not going to see it this time. But the last question I'm going to answer is John's, and it's selfish. Where does the strategic credit fund stand on its fundraise? We've got roughly 125 million of equity invested or called from investors and committed to deals right now. We should have our first distribution on January 1st. It will be 10% of NAV annualized, so 10% annualized distribution in cash to investors. And we have a really healthy pipeline. We actually have 3 deals closing in the next day and a half. And we just were allocated another bond from Freddie Mac to close in early February. So a healthy deal pipeline there. And 100, the last piece I'll note on that is we've moved to a Q structure in that fund. So investors looking to make an investment into that fund today will make their commitment. They will fund 10% right away, and the next 90% will be sitting in the queue until it is required. So if you are interested in that fund, it's better to be early in the queue than late in the queue, so you can get in sooner rather than later. Okay, I am late for the next one. Dave, it was an absolute pleasure. Thank you for your eternal optimism, and I will be looking for the string dance next time we're together. Thank you very much.
Fun without it. See you, Tom. I'll stick around and answer a couple more questions that are here in the Q&A. There were a couple that came in regarding distressed opportunities for the QOZ fund, and just QOZ opportunities in general. It's certainly something that we're tracking. The challenge that we've seen in the OZ space, at least for now, is that most of these projects were financed with 3 to 5 year construction loans. So you're starting, and a lot of those loans had, for the most cases, adequate interest reserves. For those that were capitalized with inadequate interest reserves, and they're being asked for, you know, what we'll call some level of rescue capital or capital infusions. Really, those are more in the nature of a couple million that are needed. And oftentimes the sponsors are able to get the LP to reinvest the need to top up the interest reserve. So I don't anticipate, and most of these deals, by the way, were financed with, or equity was provided with the intent to hold for 10 years. So I don't see too many groups abandoning a 10-year business plan in year 2, for example, unless they're absolutely forced to, which would be, you know, if they can't top up the interest reserve, or they have a lender, you know, that ultimately calls the note. But I don't see that happening really at scale either, because I think we're going to see what we saw in '08, and it's already happening, is that lenders are calling up some of these borrowers and saying, what do you need to extend? Let's just kick this can down the road. Doesn't mean we're not going to see an opportunity or two here or there. We're certainly tracking those opportunities, but I don't see that really being the way that we could invest the capital for the OZ fund would be in the form of a distressed deal. That said, one of the questions that came up was, would you, if there was a partially completed project, could the OZ fund step into that so long as the basis is doubled? And it's really not even, what's interesting about OZ legislation is that it's not even about the basis doubling per se. It's, can you acquire the asset before the certificate of occupancy for the project has been completed? So the project can actually be physically nearly done. So you're not even really having to invest capital that would double your basis. The key hallmark of that is that you're acquiring the property before final CO has been obtained. And there have been a number of projects that have been acquired since the OZ legislation was put in place that fall within this, this purview of the legislation. We'll certainly look for those opportunities as well. That's probably a more likely opportunity, but again, most of these deals are going to be structured as a 10-year business plan. So I don't see a lot of those, that has capitalized interest. So if you kind of start to play out the reality of how this would come about, the timing that you would need to acquire a property before it's reached certificate of occupancy, that would have to mean that the property was seeing some level of distress, and the developer and their LP would make the decision that, hey, we need to sell this asset now and take a loss or take a discount. I just don't see that being realistic, again, at scale, but always on the hunt for those opportunities. Let's see what else we have in here. How often do you reassess and reset asset values in your funds? Depends on the fund. This question came in from anonymous, but depends on the fund. Income Plus Fund establishes a monthly NAV. So that fund we reassess on a monthly basis. OZ Fund 1 and subsequent to that, OZ Fund 2 and then OZ Fund 3. Ultimately, we'll start floating an NAV there as well, and we will be reassessing those values on a quarterly basis. And then all funds go through an annual audit. So there's an annual third-party audit that we go through. So some cases monthly, some cases quarterly, and definitely in every case annually. Let's see what else. I think we're at nearly at the end. Yeah, I believe John asked a question about look at taking over and finishing a condo townhome project in a strong Florida market with a realistic potential to generate strong revenue. Absolutely, John. We would definitely take a look at it, and the devil's in the details. The question we always ask is, if there's a condo regime in place, what is the pathway to getting to collapsing the HOA? And in Florida, when we looked at some opportunities there, I think the Florida condo statutes are relatively favorable to the developer, if I recall. But happy to take a look at it. Please send me the opportunity directly, and I can send it to Kyle Verhassel, who covers that market for us. But my email address is dwielk@origininvestments.com. Please feel free to shoot that to me, and we're happy to take a look. So that, I believe, concludes the Q&A portion of it. But since Tom signed off already, I'll go ahead and sign us off again. But really appreciate everyone hanging in there for the balance of this call. Great to start the year with you all and end it as well. And we're excited, as I said before, to embark on what hopefully a few quality distressed opportunities in 2024 and beyond. And wish you all happy holidays. Take care.